Can the housing market get any worse? Is it really a disaster? And have we hit rock bottom? Well, that's what Greg Kelman of Redfin is saying. So we're going to talk about that today. And of course, look at what's going on in Phoenix too. He says we've hit rock bottom and the sales slump will last a long time. So that's great news. He does say it can't get much worse from here. So, that's a good silver lining. If that's all you have to hang on to, you're in a bad position. But he talks in this article about how high mortgage rates have crushed affordability for buyers. That in addition to nearly all-time high home prices, and we're kind of in a freeze. The sales slowdown that we have, he warns it will last a long time. He says this is the fault of high mortgage rates, and he also talks about the median sales price hitting $420,846 in August, which is close to its all-time high. And we've got those rates above 7%. So affordability is crushed, as he says. And it's at a 4-decade low. There is this home affordability index from Goldman Sachs that I thought was interesting to share because you can just really see on a graph of where we stand today. And we're very low, that's for sure. Lower than we were in that 07, 08, 09 timeframe. You can see how great our affordability was back in 2012, as well as pretty close to that in 2021 before everything went haywire. But we have done nothing but fall in terms of our affordability over the last couple of years, and here's where we stand today. So I definitely agree that we are in a place where affordability has hit a wall. He says it's a disaster. It's been a slow building disaster, as a matter of fact, and it's taking a beating because of this affordability. He also says that existing home sales have plunged to a seasonally adjusted rate of about 4 million a year, and that's down from 6.6 million a year that we saw in 2020. So we're just not seeing the number of transactions that we're used to seeing, which is absolutely true for Phoenix as well. Looking at our sales per year, we can see that we're pretty dang low compared to the last couple of years. And I had to go back a long time to see the last time we had the number of sales as low as we do today. So 2015 kind of started out there, but I'm not even going to give that the credit because it went above our sales for this year after that. So you actually have to go all the way back to 2009 to see a year where we had fewer transactions than we've had so far this year. And even that surpassed where we're at today. It just started lower than us this year. So sales per year is certainly suffering. And he goes on to talk about how, the only people selling are the ones that are forced to sell for those big life changes like a death, a divorce, maybe a job transfer, but people aren't choosing to sell and trade their home if they really don't have to. So that's the theme that we're seeing everywhere, that's for sure. And I've talked about that many times on this channel. He says this is bound to last a long time because he doesn't think affordability will improve until mortgage rates dial back. And the expectation is that markets are pricing in a 44% chance that interest rates will stay higher than 5% by the end of 2024. So we have another year and a few months for that. That's according to the CME Fed Watch tool. And Redfin expects the 30-year mortgage rate to ease to just around 6% by the end of 2023. So we have 3 more months to see if that's actually going to happen. So we'll see on that. But I talk a lot on this channel about the Cromford Market Index, which is a great source of figuring out what's going on in our Phoenix market. I'm a subscriber to the Cromford Report, and oftentimes people talk about how the slowdown that we're seeing is seasonal. And I wanted to mention that the Cromford Market Index is actually seasonally adjusted. However, they do have a measure that is not seasonally adjusted, and that's their contract ratio. So, what this looks at is the number of homes that are listed for sale as compared to how many are already under contract. And so, that ratio gives you an idea of the heat in the market. And you can see this is not seasonally adjusted because you can see these seasons. We go up and down every year. And then as we got into the pandemic timeframe, we kind of lost that seasonal pattern. And this year looks really good because we're kind of getting back to this normal seasonal pattern. Although transactions are lower and prices are high and affordability is low, we're at least seeing what we typically see in this market. And so I was happy to see that. And where we stand today is a number of 56 for the contract ratio overall. And the way that they have this measured is anything between 30 to 60 is considered balanced/warm. So 56 is on that higher end, more towards the warm side, getting kind of close to hot. But they do look at the entire valley by zip code, which is pretty cool to see. And you can see a lot of areas are that green color, which is that balanced warm. But we also have some that are in that hot area with the yellow and a few in the red that are considered hotter according to the Cromford report. So this is a pretty cool thing to see, and we're seeing that we're picking up that seasonal pattern again, even though sales are slower and affordability is low. So if you're wondering of what is going on in your zip code, I can actually pull the contract ratio for you in your zip code. So check the description to request that information if that's interesting to you. And let's look at the CMI, because I talked about this on my last update video. The CMI is starting to head downward. We are definitely seeing a softening in the market. And remember, this is not seasonally adjusted. So this is telling us that there actually is softening happening. And the reason that's happening is because we're starting to see more supply come to the market and the demand is not keeping up with it. Now, we're not in a position where our supply is outpacing the demand, but we are in a place where those two factors are starting to come closer together, which will put us into a balanced market if we continue to see this. The way they read this, any number between 90 to 110 is considered balance, and we're at 147. So we're certainly heading in that direction. It's just a matter of if it continues that way. So what does that mean for prices? Well, if you want to know where prices are heading, check out this video right here. I'll be back next week. I'll see you guys then.